Well, we're moving on to chapter 6, which involves variable costing and segment reporting tools for management. So these are two separate issues that we're going to be covering. And one of the important concepts for the first part to learn is that we are making products and we are determining the cost by having our variable cost plus our overhead, and that determines the cost per unit. Now, the more units that we make, the less our overhead is per unit because you're spreading that overhead across more products. What happens is that you are really permanently putting into your inventory overhead costs that eventually will be eliminated when you sell the product. But what happens is that if you overproduce one year and then underproduce the other because you overproduced the first year and you can't sell all of your products in the second year, then what happens is that you artificially understate your cost in the first year and overstate the second year. Because again, overhead is simply how many units did I say I was going to produce? And the more you produce, the less your overhead is per unit. So if you produce more in the first year, then you have less overhead per unit. But then if you decrease your production and keep your fixed costs the same in the second year, then you're going to have more cost into your inventory. So you need to make sure and have some way to make sure that you don't manipulate your inventory by overproducing this year, because eventually you're going to have to pay the piper, as they say. All right, explain how variable costing differs from absorption costing. So we've been talking about variable costing. So this chapter uses actual costing rather than normal costing approach that was used in job order costing chapters. This chapter always uses the actual number of units produced as the allocation base. And the chapter assumes that the variable manufacturing cost per unit and total fixed manufacturing overhead cost per period remain constant. So again, the more you produce, if your fixed costs remain constant, the lower each unit cost is. So we've been looking at variable costing, and we've looked sort of variable costing. We're saying that the fixed manufacturing overhead is a period cost. Whereas absorption costing, we're going to put that manufacturing overhead and variable manufacturing overhead into the product cost. And that is really going to be what our overhead or what our product costs are. And this is really more the financial product cost that will appear on our financial statements. Which method will produce the highest values for work in process and finished goods inventory? Okay, well, obviously, since we're adding overhead to the product cost under the absorption method, then that's going to be the answer. All right, so here's some comparison. So we produce 25,000 units annually. Our variable cost per unit is direct material, direct labor, and variable overhead $10. SG&A for each unit is $3. So we have variable costs that only occur when we sell the actual or make the actual product. So manufacturing overhead for the year is 150,000. SG&A is 100,000. Under absorption costing, and let's look at absorption costing, what we're looking at here. Absorption costing, again, we have direct materials, direct labor, variable overhead, fixed overhead. Under variable costing, all we're taking into account are these variable costs. So under absorption costing, we're adding the direct materials, direct labor, and variable, and we're also adding the fixed overhead, which is 150,000 divided by the number of units. So under absorption costing, our product costs are $16 per unit. Under variable costing, it's $10. So we assume the following, that we sell 20,000 of the 25,000 units we produced, and we sell it at $30 a piece. There's no beginning inventory because we're just starting business. So under variable costing, we've got the sales price of 20,000 units times $30. We have the variable cost of $10 per unit, and we have the variable administrative expenses of 60,000. So our total variable expenses are 260,000, which means our contribution margin is 340,000. We add in our overhead, which is 150,000 for manufacturing overhead, and then our period cost really, and that's 250. And so our net operating income under the variable costing system is 90,000. And this is really just an internal management report. You don't, from a financial standpoint, you're going to do absorption costing. But this gives you an idea of what your true costs were that year. Under absorption costing, again, we are allocating the same things here. Cost of goods sold, okay, so that's gross margin. And then we're going to allocate some of the variable cost of $3 and all of the fixed costs, but not all of the overhead, okay? And so that's $120,000 profit, which is 30,000 more. And what happened to that $30,000? Well, it's in our inventory. We have deferred $6 into our inventory. However, that is correct for financial reporting purposes, but this again is an analysis that we're doing to make sure that we're on the up and up. So we're going to reconcile the variable costing and absorption costing. And really, again, under absorption costing, all of the manufacturing overhead goes into the cost of the product. And since we didn't sell all of those products, then we have basically kept $30,000 in ending inventory. Whereas variable costing, we're going to expense that. We still have the same total of expenses, but for absorption, we're keeping $30,000 in overhead. Once we sell these products, that will go away. So again, we see that really the difference is what's going into overhead. Now in year two, we'll have a different result. Again, produce the same number of units, but now instead of selling 20,000 units, we're going to sell the 5,000 we had in inventory plus all of the ones that we produced this year. So our unit sales price is $30. Our variable costs, again, are still 10 and 3, and our overhead is the same amounts. Under absorption costing, same thing. This doesn't take into account, um, we're not spreading the overhead here because we were just looking at the variable cost. All right, so variable costing, again, we sell 900,000 units. We have the variable cost for the manufacturing and for the SG&A of 390. So our contribution margin is 510, and we don't have any of the prior overhead to allocate here. So our profit is going to be $260,000. Now, in year one, our variable cost profit was $30,000 less than our absorption cost. Here, it's going to be the opposite. And why is that? Because we're now taking that $30,000 that was in inventory, and because we've sold that, it becomes an expense. And so our gross margin is lower, and so our net operating income is lower. Now, for the 2 years, it doesn't make a difference, okay? But you never have a scenario like this. Number one, you're going to want some beginning inventory. You don't just suddenly go, okay, I'm not going to sell anything. I'm going to make everything I sell. All right. So again, this is reversed because of the $30,000 that was in inventory. So you see that the total for the 2 years of profit is going to be the same, but the absorption, we're absorbing the manufacturing overhead and we're not going to expense it until we actually sell the product. Whereas variable, we're counting all of the costs and we're only looking at um, we're not really taking into account the fact that we're putting things into inventory. Same thing. Now, granted, if you didn't sell the 30,000 units, if you only sold 20,000, this would be different. But then you now have 10,000 units in inventory, so you'd have 10,000 units worth of overhead. So, relationship between units produced, effect on inventory, no change, inventory increases, etc. So here is a relationship between variable and absorption incomes. If the units produced equal units sum, absorption equals variable. If the unit produced are greater than the units sold, then the absorption profit is going to be greater than variable. If the units produced is less than units sold, we're pulling in some of those costs from the prior year, and so absorption is going to be less than variable. So variable costing categorizes cost as variable and fixed, so it's much easier to use this income statement format for cost volume profit analysis. Absorption costing assigns fixed manufacturing overhead to units produced. A portion of fixed overhead resides in inventory, and the units remain unsold. Variable costing income is only affected by changes in unit sales. It's not affected by the number of units produced. Whereas absorption cost, it is, because the more units you're producing, the more overhead you're spreading to other units. So variable costing correctly identifies the additional variable costs incurred to make one more unit. Absorption costing assigns fixed manufacturing overhead to units produced, gives the impression that fixed manufacturing overhead is variable, but it's not really.